Okay. So as I was saying, when it comes to incorporation, there are two taxes that need to be looked at: income tax and capital gains tax. We said that for income tax purposes, because the company is a separate legal entity, the sole trade business, it will be the cessation of trade for income tax purposes and the start of the new trade for New Co Limited.
Okay.
Therefore, on cessation of trade for income tax purposes, what needs to be considered? A few things need to be considered. Number one is closing year rules need to be considered. Overlap profits therefore need to be considered because, as you know, overlap profits arise on the commencement of trade, and you can get relief for the overlap profits either on the change of an accounting date or on cessation of trade. And finally, terminal loss relief should be considered. So that's always like your introductory paragraph on the tax implications on incorporation. Did that make sense?
Yep, thank you.
So 3 things: cessation of trade, overlap profits, and terminal loss relief potential.
Correct.
Then we go on to look at, we sit on the income tax implications, and within income tax implications, there is a subheading on capital allowances. So the implications on capital allowances need to be considered. And we know that on cessation of trade, no annual investment allowance, writing down allowance, or first year allowance is available. So in the final period up to cessation, no AIA, WDA, or FYA is available. Happy with that?
Yep.
Okay. So effectively, it's the assets are going from a sole trade business into New Co Limited. So it's effectively a disposal. New Co Limited and the individual sole trader are connected persons, right? Because sole trader will effectively become 100% shareholder potentially in a New Co Limited. So for capital allowance purposes, the assets on the pools, there will be balancing adjustments arising, either a balancing charge or balancing allowance. What that means is the assets will go over to New Co at market value because they are connected parties. And this will therefore give rise to balancing charges or balancing allowances. It will be a balancing charge if the market value is higher than the tax written down value, because effectively you claimed more capital allowances than you should have. And it will be a balancing allowance if the market value is lower than the tax written down value. This balancing allowance or charge will affect your tax adjusted trading profits. If it's a balancing charge, you add it on, therefore subject to further income tax either at 20, 40, 45%. And if it's an allowance, you are saving tax at 20, 40, 45%. Is that all making sense?
Yes.
Good. Now, to avoid, let's just say the sole trader is an additional rate taxpayer, and that's the whole reason why the individual is looking to incorporate, because he's paying 45% tax. He or she is paying 45% tax plus NICs at 2%. That's no good. Now, having this balancing charge arising on him or her would mean that a further amount is subject to 45%, okay, which is no good. In order to mitigate this, what do? We make a joint election under Section 266, Capital Allowances Act 2001, whereby the assets will move across into New Co at tax written down value.
Okay.
Now, assets going across at tax written down value means there are no balancing adjustments, and New Co Limited will have effectively the base cost. Obviously, we're not talking capital gains here, but the base cost of tax written down value, and it just carries on as normal. Okay. The final thing to consider would be if, as we said in our example, the individual was paying tax at 45%. Now, in order to potentially save tax at 45%, you could, as the two entities are connected, you could fix the consideration of the assets at £1, for example. What does this do? This brings in a disposal value in the sole trade capital allowances computation of £1, therefore giving rise to large balancing allowances.
Oh, okay.
Because let's just say the assets were 50,000, the tax written value was 50,000. You bring a disposal figure of £1, therefore 49,999 is the balancing allowance. This is a deduction from tax adjusted trading profits. Therefore, you have effectively saved tax 49,999 at 45% plus 2% as well. So it's a tax saving strategy potentially. However, there's always a flip side to it, a disadvantage you could say to it, which is that the acquisition figure for Newco would also be the £1. So effectively, Newco will not be able to claim any capital allowances. They can, but it'll be 18% of £1, which is 18 pence.
Yeah.
So it's not really, so in terms of that, it's not, ideally the best situation would probably be tax written down value.
Okay.
Again, it just depends on the whole scenario. But these are 3 or 4 things we mentioned to consider. Number 1 is no AIA, WDA, or FYA in the period up to cessation. Balancing adjustments will arise. You could potentially make a joint election under Section 266 to transfer tax written down value, or you could fix consideration at £1 to give rise to large balancing allowances. Now, just an additional point on the joint election. It must be joint and it must be made within 2 years from the date of incorporation. So let's just say you incorporated on 31st March 2021. You need to make the election by 31st March 2023.
Got you.
Any questions so far?
No, that was really well explained. Thank you.
Moving on, we're still on the income tax implications. We went through the general implications. We went through the capital allowances implications. Now we move on to the stock implications, because again, effectively stock is moving from one entity to another and it's a connected entity. Therefore, the stock moves over at market value as well. This will most likely give rise to further profits, because effectively you have to treat the stock as being sold to Newco Limited. And therefore, obviously, when you buy the stock, you buy it and you plan to sell it at a higher price. So therefore, most likely there will be profits, which is also subject to income tax on the sole trader. Now, to mitigate this or to avoid this, again, a joint election may be made. I've forgotten the section number, but again, a joint election may be made and the stock goes across at tax written down value effectively.
Okay.
So that's the implications for stock. The final point that you could consider is cash is retained personally and debtors and creditors are netted off and settled personally as well. Okay, so that cash, debtors, creditors does not move across into Newco. Is that okay?
Yep.
Okay, that's the income tax implications. Now, they could ask you that. They will ask you the capital gains tax implications. And the first line that you can always note down is the incorporation of the sole trade business or the partnership business will give rise to capital gains tax implications due to the chargeable disposals arising. I'm not sure if I worded that too well, but what I'm trying to say is on incorporation, effectively, certain assets will be disposed of and acquired by NewCo. Therefore, it'll be a chargeable disposal subject to capital gains tax. Okay, and usually the two you always look out for would be land and buildings and goodwill.
Okay.
So you'll always have land and buildings and goodwill. Now, sometimes land and buildings will be retained personally, meaning it's not a chargeable disposal. It's not going into NewCo. So then it'll only be goodwill that you're looking. Okay, but I'll explain both. So we'll start with land and buildings. Effectively, and it'll make more sense when we do this question, effectively, let's just say AM, which is you, sole trader, you own land and buildings where you trade from worth 500,000. Okay. And AM Limited is being incorporated. So now when you transfer the land and buildings, although you're the 100% director shareholder of AM Limited, still separate legal entities, right? So effectively, for capital gains tax purposes, you will be disposing of your land and buildings worth £500,000. And as we know, for capital gains tax purposes, AM and AM Limited will be connected.
Okay.
Therefore, disposal proceeds will always be at
market value.
Market value, exactly. So you can't play around with that. It'll always be at market value. So let's just say you purchased the land and buildings for 50,000. Disposal proceeds 500,000. Therefore, a capital gain, chargeable gain on you of 450,000, less the annual exemption, and potentially subject to 10% tax. Why? Because you'll need to have a look whether business asset disposal relief is available. Usually it will be, but you just need to double check.
Okay.
Effectively for the company, they would receive they will have the land and buildings on their balance sheet at market value 500,000, and that will be the base cost going forward.
Okay.
The second thing is goodwill. Same sort of implications or understanding, which is market value disposal due to connected parties, less base cost. Sometimes they'll give you a base cost. Most of the time it will be nil, okay, because it would have been internally generated goodwill. And again, let's just say 1 million goodwill again. The only thing here you need to remember, which is an important point, which you can definitely pick up a few marks for, at least 1 or 2 marks, is that business asset disposal relief will not be available. Why? Because there's a specific exclusion, you could say, under section 169 TCJA 1992, which is that if goodwill is being transferred to NewCo, whereby it is a closed company and you hold more than 5% of the share capital, then goodwill, then BADR will not be available. So just keep an eye out for that. Did that make sense?
Yes.
Excellent. Now we have all these implications. We're talking 450,000, 1 million in our example. And obviously this will put anyone off in incorporating, okay, because you'll have massive cash flow issues potentially, because you're still you're not actually disposing of anything, and you'd have to cough out the cash to pay the tax. Therefore, there are reliefs available, and the the first relief that you need to look at would be incorporation relief under Section 162, TCJ 1992, which effectively rolls over or defers any gain arising into the base cost of the new shares in Newco Limited. So any gain arising is deferred into base cost of the new shares in Newco Limited. Again, this relief is only available subject to 3 conditions being met or satisfied, which is the transfer must be as a going concern, all the assets must be transferred, and the consideration must be wholly or mainly in the form of shares. Okay. Now, the normal stumbling block for incorporation relief not being available is when it comes to all the assets must be transferred. So if all the assets are transferred, yes, incorporation relief, you just roll over the gain into the base cost of the new shares. Okay, so effectively when you dispose of the shares, you'll have a lower base cost. But if all the assets are not transferred, for example, sometimes the sole trader or the partners within the partnership prefer to retain the land or the building personally, therefore you will have no incorporation relief available, then what needs to be looked at? You can always look at gift holdover relief, which is that the individual assets you claim, you make a joint election for holdover relief, and the gain is rolled over into the base cost for the company of that asset specifically, not of the shares of that asset. So effectively, the company then has a lower base cost of the asset and would be subject to corporation tax with a lower base cost. Any questions?
That's all good, thank you.
Okay, so effectively, what if obviously subject to the question being relative, directly relative, everything we spoke about can potentially get you, if it's a 20-mark question, and if they ask for income tax and capital gains tax implications, you can easily get at least 17 marks, I would say.
Okay.
Obviously, there'll be bits and bobs which is specific to the question. So let's just say you'll definitely hit 15 marks, and then there'll be bits and bobs relating to the question which you need to sort of look at, discuss. And there may have been 1 or 2 things maximum that I've missed out, but that's just, again, specific to the question. Okay. Do you have any questions before we move on to Mr. Hodgson?
Not at the moment. All good so far, thank you.
Okay, so as normal, let's have a read of Mr. Hodgson, and then we'll tackle the question together.
Mr. Hodgson has run his own business, Hodgson Carpentry Services, as a sole trader for many years. He is considering the incorporation of his business. The following information is relevant. Mr. Hodgson's last accounts were for the year ended 31st of March 2021. They show a turnover of £175,000 and a net profit of £80,000. He has no other income. The business is run from freehold.
What are your thoughts?
On the first one?
Yeah, what have we got?
Wouldn't he retain that income?
Yeah, exactly. He'll be taxable on that income for now, correct? So we have a sole trader, Mr. Hodgson. He'll be taxed on the net profit or the tax-adjusted trading profit for the year ended 31st March 2021, right? Now, the other thing I know about this date is that they haven't mentioned any start date, so there'll be no overlap profits. And effectively, Newco will come into play from 1st of April 2021.
Okay.
Okay, that's fine.
And
the
also,
business,
sorry.
Yeah, sorry, he's also a higher rate taxpayer. Looking at these figures, higher rate, most likely.
Okay. The business is run from freehold premises owned by Mr. Hodgson. The business has 8 vans which are used 100% for business purposes. Mr. Hodgson also uses his private car for business purposes, and mileage records indicate that the business use percentage is 60%. There's also a significant amount of plant and machinery and computer income. The initial thing that jumps out at me is the fact that if he becomes a company, this whole private use of his car becomes irrelevant.
Excellent. Good. Good.
8 vans. And as he's transferring over an asset to his, well, would cause freehold premises. So this freehold premises, if he was to transfer that over to the company, would we consider badger relief? So business asset disposal and the plant and machinery and computer equipment.
Exactly. Exactly. Good. So if the premises is sent over or transferred over into NewCo, then it'll be a disposal for CGT purposes, but potentially covered by business asset disposal relief. Okay. Now, there are also a significant amount of plant and machinery and computer equipment. So that tells me capital allowances. And as we just discussed, you talk about the whole thing, which is no AIA in the period of gestation, etc., and then you can talk about the whole balancing adjustments and the election. Now, as I said, there'll always be something specific to the question, which is this part here. Mr. Hodgson also uses his private car for business purposes, and mileage records indicate that the business use percentage is 60%. So as you correctly mentioned, when it goes into the company, there will be no sort of, what do you call it? What's the word?
Private use.
Yeah, private use. So pro rata.
Yeah.
So if you transfer the car into the company, if the car was also transferred into the company, but he uses it 40% for private use, right? Then there will be a benefit in kind, right? Because now the company owns the car, but he's still using it 40% private usage. Therefore, there will be a car benefit charge as well as a fuel benefit potentially, which will be subject to his marginal tax rate, subject to income tax effectively as some sort of employment income. And the company would also be subject to Class 1A NIC. So that will give you a mark or two, and that is one of the specific parts of this question.
Okay.
Did that make sense? Any questions?
Yes. No, that's fine.
Now, and mileage records indicate that the business use percentage is 60%. So what he can also do potentially is you leave the car with him personally as an individual. Don't transfer the car over to NewCo. And what you do now is you keep the car personally, but you use the car 60% for business purposes. You keep a mileage record of your business miles. And then what do you do?
Claim the business miles back from the company.
Excellent. Which is that?
I'm not sure.
It's the whole 45 pence for the first 10,000 miles and 25 pence thereafter. Okay. So effectively, it's difficult to say. They haven't given us any figures. They don't give us the CO2 emissions. So what you would mention if you're advising Mr. Hodgson is that we will need more information, and we can then do comparative calculations and then come to a decision. Obviously, once you claim the mileage, you can't then change. Once you've claimed the mileage for that car, you can't then bring it in as capital allowances, and vice versa. Once you bring it in as capital allowances, you can't then start saying, okay, next year I'm going to claim mileage. It's like your decision is done.
Okay.
Let's continue, please.
His wife works part-time in the business and is currently paid a salary of 6,500 per annum. She has no other income. I don't know how that plays a part into it.
So she's paid a salary of 6,500. So
Yeah.
currently, ignore the whole company. As a sole trader, where will this show? How will it be assessed?
Would it not be an allowable expense as a salary to an employee? But then we'd kind of have to check if she's getting paid what a usual employee would be paid.
Excellent. Very good. Exactly what I was looking for. So it'll be an allowable deduction for the business, and you just need to assume, again, we don't have further information, but you can assume that, or you can mention that as long as this 6,500 is in line with duties provided for the business, then yes, it will be an allowable deduction. Now, that's covered by her personal allowance.
Yes.
And that is covered by the primary threshold for NIC purposes.
Okay.
So at this moment in time, there would have been no implications on the wife.
Okay.
Now, he's considering incorporating his business. So what does the question say? Discuss the tax and NIC implications of the incorporation of the business, the cessation of the sole trade, and the benefits of trading as a limited company. Detailed calculations are not required, so that's why we can happily mention that this will need to be considered, that will need to be considered, but we don't need to do the calculation because we don't have enough information anyway. But yes, we do need to discuss the tax and NIC implications. So we are saying that this 6,500 would have been covered by the primary threshold. Okay. So now, what shall we do on incorporation? What shall we do with the wife? How should this be structured? What is the best way we can do this? Or what needs to be considered?
As a business?
Either. So you can, anything that needs to be considered, we will need to talk.
I'm not too sure.
That's fine. So, so the first thing that we can consider is if she becomes an employee of the limited company, then again, as long as it's subject, as long as it's in line with her duties and it's a market value rate, then that 6,500 would be an allowable deduction, effectively saving corporation tax at 19%. And she will have no further implications. Why? Because it'll be below the primary threshold and within the personal allowance. Okay. Now, and the company would also potentially be subject to class 1 secondary contributions at 13.8%. However, if she's the only employee, then this will not be an issue. And also, if it does exceed the thresholds, then the company can always claim the employment allowance. Okay. The employment allowance is £4,000, which in effect covers the employer's class 1 secondary contributions. Class 1 secondary contributions are also an allowable deduction for the company if they were to pay any.
Okay.
Now, the other thing that can be thought of is, obviously, you could potentially increase the salary as much as possible, as long as it's not excessive, therefore saving more tax at 19%. But then obviously you need to look at, once you come to around 9,500, then anything in excess would be subject to NIC's class 1. Okay. The other thing you can discuss would be to bring her on as a shareholder.
Okay, and pay her dividends instead.
Exactly. Now, that will be fine. There will be no sort of excessive dividends or anything of that sort. You can pay her the salary that you're currently paying, but you can also pay her dividends, thereby making use of the 2,000 dividend allowance, as well as the remaining personal allowance, as well as the lower rates of income tax, which is at 7.5%.
Okay.
Again, you'd make a comment saying that we'll need to get proper figures to determine whether this is a beneficial way to go forward, and quantify the tax liabilities. In terms of, let's go back to Mr. Hodgson. What can you say about the way he's been? Let's just say Mr. Hodgson will become an employee of the company, right? And receive dividends. In terms of the administrative side of things, what will be the implications? What will be his duties? How is he being taxed now? How will he be taxed as an employee of the company? What are your thoughts, please?
So he's being taxed as a sole trader. I'm not too sure. Trying to think.
Okay, that's fine. So as a sole trader, he's effectively treated as self-employed. Therefore, he will get his UTR number, and he will be required to file a self-assessment tax return. And for the year ended 31st March 2021, which is the 2021 tax year, he will need to submit his self-assessment tax return by 31st Jan 2022 and pay any tax due as well. Okay, he will also be subject to Class 2 and Class 4 national insurance contributions. Now, once he becomes an employee of the company will operate a PAYE system, and he will receive pay slips in essence, and he will be taxed at source. Meaning, for example, you work for KPMG, you receive a monthly pay slip, gross amount, but they don't pay you the gross amount. They take off tax and NIC and student loan deductions or whatever it is, and they pay you the net amount. So effectively, you've been taxed at source, meaning at source, you haven't received the tax, it's just gone straight to HMRC. If he wants to receive dividends, then he'll still need to file a self-assessment tax return. However, for any tax paid under PAYE, he will receive a tax credit. He won't be subject to Class 2, Class 4 anymore because he's not a self-employed individual. He will rather be subject to Class 1 primary contributions, again, taxed at source under PAYE.
Okay. Should we continue?
Yeah. Does that make sense? Any questions?
Yes. Not at the moment.
Effectively, it's a good question in the sense that it's quite broad. You can talk about loads of different angles. It's just about
it's definitely
you
making us think about different taxes.
Exactly. It's just about you realizing that okay, I can talk about this for a bit, get a few marks here, I can talk about that. It's just I think the more we keep talking about it, the more things start clicking together, and you start realizing, okay, there's that I can talk about, I can mention this, and all this is picking up half mark, 1 mark, which makes all the difference when it comes to CTA, because the amount of people that get between 45 and 50 is crazy. I've been there as well. I got 48 for this paper.
That would kill you.
Yeah, it was. It's obviously long because you then have to wait 6 months, right? For the next sitting.
For the next one.
And you have to wait 9 months effectively to get your results, because the results, they take a while.
Yeah.
So, 48. People that get 49, I feel even more sorry for. But but that's what I'm saying. These half marks are very good when it comes to CTA. Okay, let's move on. Mr. Hodgson.
Mr. Hodgson originally purchased the business for £30,000 from his father in 2001, of which £5,000 represented the market value of goodwill, and the balance was allocated to plant and machinery. Okay, so father of which this goodwill that we spoke about, it will be disposed at market value, which was £5,000. So if he was to give the goodwill over to the business, he would dispose it, well, for, is it CGT purposes that he would dispose it at market value?
Exactly. Yes.
And then,
Now, yeah.
sorry, carry on.
No, this 5,000 represented
Yeah.
market value when he originally purchased the business. So that would be base cost. They haven't given us the market value now.
Oh, okay.
So effectively, it'll be market value now less 5,000, which will be subject to capital gains tax.
Why wouldn't that be market value? Sorry.
Because it says Mr. Hodgson originally purchased the business in 2001,
Yeah.
of which 5,000 represented market value of goodwill in 2001.
2001. Okay.
That would be base cost. So again, we don't need to talk, detailed calculations are not required. So you'll just discuss and explain everything we said at the start, which is disposal of goodwill will be on market value as they are connected, subject to capital gains tax. It would be market value less 5,000. And then you can start mentioning the whole thing, which is that no business asset disposal relief will be available in respect of the goodwill, as the transfer is to a close company whereby Mr. Hodgson will own more than 5% of the shares. And then a side point you can mention is, therefore, because this goodwill will be taxed at 20% and the freehold potentially at 10% because BADR will be available, you use the annual exemption against the goodwill element in priority.
Okay.
Does that make sense?
Yes.
Okay, and then you can also say that the freehold premises, you'll discuss the CGT implications again, connected party, therefore market value disposal, less base costs. Most likely you can discuss the BADR conditions and say most likely these will be satisfied and subject to CGT at 10%. Okay? Subject to CGT at 10%. What does this mean? It means that it means that the annual exemption will be used against the goodwill in priority. Then you can bring in incorporation relief. You can say that as long as the premises and the goodwill is transferred, well, the goodwill will be transferred, but as long as the premises is also transferred to NewCo, incorporation relief will be available under section 162. And you outline the conditions. You'll have the conditions in front of you in the exam, and you'll simply mention them, and you'll get a mark for that. And then you can say, however, if he retained the freehold premises personally, then incorporation relief will not be available, and you can start discussing gift relief under section 165.
Okay.
Does that make sense? Do we have any questions?
No, all good so far. Thank you.
It's a 15-mark question, so everything we discussed would get you potentially 14 marks at least. So
yeah, there's definitely a lot to talk about, is what I'm thinking.
Yeah, this question is amazing. Like, if I got this question back then as well, because I remember I focused on a few specific areas. It's not the best. Obviously, I left it a bit last minute as well. It's not the best way to do things, but I was sort of hoping for certain questions. And if this question came up, incorporation didn't come up for me, unfortunately. But so what you need to do is just keep practicing loads of questions, and you'll start realizing that after a while, it's the same sort of, the backbone will always be the same. You can't have anything different. As I say, each question will have its own specifics. But if you understand the backbone of each thing that's going on, for example, incorporation, purchase of own shares, what else do we have? takeovers. Takeovers is part of the syllabus, right?
Couldn't tell you. I think so.
Yeah, I think takeovers.
This is how far behind I am.
Fine. Yeah, sale of shares, sale of trade and
Yeah.
assets. It's all part of the syllabus. If you get the backbone of it, you can get your 50%, which is what we're looking for. Obviously, I think we should look for 60% when we're studying. We look for 60% when we're studying. And don't be put off by everything I'm saying as well. I'm saying I'm probably giving you a 90% answer, meaning you will get 90%.
Yeah.
But obviously, it doesn't matter if you're not looking to get 90%. So you just need to absorb as much information as possible, and just, as I say, the backbone would give you the majority of the marks, and the backbone always stays the same. Okay.
I think it just there's an instant fear when you know how difficult it is to pass.
Yeah, I think that is like a a psychological thing, right?
Yeah, like instantly I'm like, is there really a chance?
No. I think that there's definitely a chance.
Yeah.
But I know what you mean. I know exactly what you mean, because like everyone just goes on about how hard it is, and how difficult it is, and everyone's failing. But you know what? 50% do pass, 50 to 60%. So it doesn't mean you can't pass that. And if you keep working hard, you've got about 5 weeks, let's say. You've got 5 weeks. Just keep, as I say, my advice to you now is, yes, do look at the study manuals on specific areas you find difficult. However, you just need to keep on doing practice questions.
Okay.
And hopefully our session on 10th April,
yes,
this is exactly what we'll be doing. We'll go through 6 questions.
Oh wow, that's really good.
Yeah, which is effectively 100 marks. I'll pick out questions worth 100 marks, and we'll just talk about it.
Okay, perfect.
I'm just going to get a drink really quickly, and then we'll move on to the next question. Is that okay?
Yeah, that's fine.